Good afternoon, everybody. Welcome back to my channel. Yes, it's your boy coming through with the third video. I'm thinking about doing one more video. See, I got the guns out. Been in the gym getting ready for Brazil, Rio de Janeiro. Yeah, holla at your boy. Let's get it. Today's video, we're gonna put you up on some stocks that I'm personally side note. I'm personally investing in some of these stocks. Some I'm not invested in, and I'll let you guys know. Uh, but two that I'm very interested in. One I already have in my portfolio. One I'm thinking about adding into my dividend portfolio. But I have this article from Investor Place, and remember, remember, the goal is to produce passive income to make money so that your money can compound. The three levers in dividend growth investing is you contributing money. It's the triangle. You contributing money to your portfolio, the stock increasing its dividend, and then you reinvest in the dividend. The holy trifecta. Right here, it says the three dividend cash cows of stocks for steady dividend income stream. This is what we have here. We have American Express, we have Walmart, and we have QUALCOMM. If you are in the dividend investing community, or if you know about information technology, you know about QUALCOMM. But if you are not into stock market investment or dividend growth investing in general, you're not going to know about QUALCOMM. Everyone knows about Walmart, cost effective. So whether you are in college, you learn about how cost effective in their business strategy, yada yada yada. And then you have the American Express. Let's break it down. I'm not going to even talk about Walmart, even though Walmart had a good year in 2024. And I believe they are doing a stock split, and they actually increased their dividend by relatively a lot compared to Walmart capabilities. But I don't recommend investing to Walmart. I would say compared to Walmart, even a comparable comp would be Costco. Now Costco low yield at like 0.78, 0.8%, but the stock price, the rate of return, the the dividend increases over 12%. The full return roughly like 20-24%. Costco is a beast compared to Walmart. Now, American Express. American Express is the leading credit card firm that has a higher yield. I am personally investing into American Express, and I want to show you guys right here because you don't want to talk. Hopefully, you don't want to talk about stocks that you're not personally investing into, because then it's like you're a hypocrite. Next week, when I deposit around $1,500 into the stock market, I'm going to buy roughly $300 worth of American Express, so I can get this amount of. And I also plan on right here, and I also plan on, if you see, yeah, if you see, I plan on purchasing, uh, you know, roughly $100 into American Express. Uh, Roughly, over the next couple months uh, for 2024. So I believe in American Express. It has a higher yield than Visa and Mastercard, but also just know that Visa and Mastercard are the OGs. They are what would you call it? A duopoly. Yeah, so they're a duopoly, meaning that they have a chokehold on the market. So typically, when people think about those type of financial fintech companies, they either go with Visa or Mastercard. I'm rocking with American Express because the dividend increase is just increased its dividend by 17%. Last year, it increased the dividend about 7%. The year before that, it increases its dividend by 15 to 17%. And also, I bought American Express at 208. It's at 223 right now. And when I bought it at 228, I was trying to buy it at 190. So that tells you how fast this stock grows. It grows fast on the level of a MasterCard and Visa, where I really wanted to buy it at 190, but when I bought it at 208, I was like, oh well. And then I was really reluctant to buy at 208, and then it went to 210, 215. And I was like, okay. And then it went to 223. So usually, if you have a conviction on a stock, it's better to buy now or buy in at that period of time, because you never know if time in the market beats time in the market. It is what it is. So American Express is 223.37 per share. You can dollar cost average into American Express, and then boom. Oh, and here's a couple articles right here. Look, look, American Express rewards shareholders with a 16.7 dividend hike. That's crazy. That's filthy. Last company, Qualcomm. Well, yeah, Qualcomm. So it's the tech play. It costs $170 .57. It's in the smartphone market. It's the chip company. It's a semiconductor company. It's in smartphones, and right now it's competing in the market, trying to get shares with the AMD and the Nvidia. And if you honestly look at the if you look at the stock price, if you look at the stock price of Qualcomm over the span of this year, I wanted to buy it at 150, and it has recently shot up to $170, $180. Yeah, and so right here you see year to date, Qualcomm is up 17%. It was at 139 at 153, 141. This is the best time to buy it, right? But my mind wasn't on it right now. I recently been thinking about Qualcomm at the beginning of March, and look right here, at the beginning of March. See, I was thinking about it because I wanted to buy it around the 150 range. Now, how you go from 155 now is at 175? See, that's what I'm saying. Like when you think about you want to buy something, a lot of times we drag our feet on a lot of things, and we be like, oh no, nah, blah blah. It's just pull the trigger, because if I was, it's down to 170, but if I would have just thought about it and just would have pulled the trigger at around the 150, 155, $154 range, and just would just keep it pushing, guess what? My shares would be up to around 175, 170, and I wouldn't be complaining. But now I'm just like, okay, I wish I would have got into Qualcomm at 150. Sucks for me, right? I know you're like, boo hoo, whatever, Kadero. Who cares? I care, because I love the tech play. Qualcomm has a 1.88% dividend yield, has a payout of roughly 35%. It's under 50% payout, and then it grows its dividend roughly 5, 7.5, 8%, and has been paying a growing dividend for 20 years. And so it pays also 80 cents per share. Well, 80 cents per quarter per share. So it's valid. It's definitely valid. And for the last company, because I wanted to give you guys just one third company before I leave. It's Costco. It's the beast. I know the article had Walmart. Forget Walmart. Costco is a beast. Year to date, it's up 9%. It had some type of earnings call recently, and so it kind of dropped. Man, my Costco shares, because I have my dividend growth portfolio and also in my growth portfolio as well. I bought Costco around 550 $550, and it's all the way up to a couple days ago before the earnings call. It was approaching $800 a share. I was loving it. Now it's down now. It's down now to $725, and so your boys, I'm going to buy some shares. And then honestly, I hope it falls some more. If it falls to like 685, 690 range, oh yeah, I'm buying 250, $400 worth of Costco, because I know in the long run, this stock right here, due to the increase in membership and people uh just devotion and consistency, and then them open. Not only the Costco is not also it's not only in the United States, but it's also in like other parts of the world, in Europe, Eastern Europe, and that I think it's also in some Costco's in China too. I think I saw they had some stores there, and so it's also I'm getting international exposure investing at the Costco as well, and they also grow a lot faster, increases dividend a lot faster compared to Walmart. It's the honestly the better buy. Yeah, the dividend yield is a lot lower, but the payout ratio is 13%. So 5 year growth rate 12%. My goodness! And then it also pays a special dividend like every 4 years. They just recently paid a special dividend of $15 per share outside of the dividend they paid. Like this stock is a beast. Ooh, I'm getting so excited, man. This stock is so delicious. This stock, man, it's so sexy, man. So all in all, the three cash cow stocks to beefy up your portfolio with dividend on a steady income stream. American Express, holla at your boy. You know I got that. I got that. QUALCOMM, and then also Costco. And then if you think by Costco being roughly 725 is too much, you can always dollar cost average into it. And real quick, that's what I'm doing right here. So I buy $100. Well, tomorrow, this next week, I'm buying a little bit more, but I'm just buying $100, $100, 150, 150, 220, 320, 320, 300, 225. And so when you dollar cost average, you just take dollar cost average is really you just taking a buyout apple. 100, so right here, so you take it into pieces. So if you know that you don't have the full 700, guess what? 1, 300, 400, 500, 650, boom. That's one share. And then guess what again? 2, 5, 8, 8. That's another share. 1. Wait, 225. What's that? So right then and there, you don't have to have the full stock price amount to buy the stock. You can dollar cost average and buy $50 worth of that share. 25, 100, $1. But everything adds up. And guess what? The shares that you bought last month plus this month, it adds up to one share. So if you have to complete $725 to buy the share, then bravo. Or you can just do like what I do and what a lot of people do, dollar cost average into these high ETFs or shares of stocks and become owners. All right. That's it. These are the three dividend stocks for a steady income stream. Hope you guys enjoyed this video. I'm out. Peace.